Probably don't need to tell you a lot about AJB, but just quickly to reiterate that we've been recommended by Which, again, as a recommended provider. I'm sure you all know about the growth of the business over the last 20 years, so I won't reiterate that as well. But what I do want to talk to you about a bit more is AJB Investments. We are a slightly younger business within AJB, set up in 2016. We've grown assets relatively quickly for an asset manager, now at £7.5 billion. As I said, from customers such as yourselves and advisors. If any of the investors are in the room today, thank you for trusting us with your money. Along the way, we've picked up some industry awards for the quality of our investment proposition. Highlight the one that's got my job title in, quite like that one. Also, we've picked up some awards for our performance over the years as well, to bolster our credibility. Our mission, in terms of what we want to do for you and your investments, is to give you peace of mind, feel good investing. Like this chap here, put your feet up, feel good about your retirement investments. And we do that through a pretty simple mantra around simple, transparent and low cost. And everything that we do within AJB Investments comes back to those three tenets. Simple in that everything that we do in terms of constructing a portfolio is relatively simplified. When you buy one of our funds, you get an instant portfolio that's very, very diversified with thousands of underlying investments there. So it's not reliant on any single companies within that portfolio to perform or not perform. And we keep the asset classes that we use in the portfolio straightforward and understandable. So equities, stocks and shares, and bonds, and a bit of cash as well. We believe in keeping costs low because it has the ability to impact your long-term compounded return. If you keep costs low, it's a controllable, it makes a big impact. And we're not complacent with low cost. We don't just pick the lowest cost products in the market at any given time and then stay invested. We try to consistently look for efficiency savings along the way as well. And at the end of the day, that means that more of your money is invested and able to compound over the long term. And then finally, transparency. The money that we manage is not our own money, although I am invested in some of the funds. It's your money, and we like to keep grounded within our team and remember actually who we're managing money for. It's not our money, it's yours. So, keeping that in mind, we like to be transparent with all our holdings. So you can look on the website at any given point in time and see a full breakdown of the holdings within the portfolios. We try to keep you informed with regular communications via emails, videos, articles on the website. We like to think it's easy to access and it's improving over time as we get bigger and bigger. In terms of our funds, it's not just one fund that we offer. We have a commitment to giving you choice in terms of investments. So that means that we offer 6 growth funds, which are risk rated for different levels of risk or volatility, as some put it. We've got 2 income funds, which I'm going to talk to you about today because they are quite thematic given the theme of today. And then we've got a responsible fund for those that want to manage their ESG, environmental, social and governance risks in their investments as well. Now, generating income in retirement can be relatively complex. No 2 retirements are the same. The way that people retire is changing over time. People are no longer thinking about retirement as a day that they put down tools. More and more people are actually working throughout their retirement in part-time jobs or changing careers slightly. Now, the old solution to buy an annuity, as Tom was saying earlier, is no longer the sole option. There's flexibility available to you. I'm not going to talk a lot about annuities because I think we've hammered them quite a bit today anyway. But in terms of keeping your money invested in your retirement, there are lots of different options available to you in terms of managing that portfolio of assets. So that could be that you keep the asset allocation relatively fixed over time and you take out capital, monthly, quarterly, whatever. But that requires that you need to manage the portfolio through time. When you make a sale, you need to make sure that the portfolio is relatively well balanced in terms of taking risk. If you take the income approach, you take the natural income, or you can take a set level of income. You need to do the same exercise. You need to be managing your investments monthly, quarterly. Then there's another approach that financial advisors tend to like to use. They bucket people's investments. So by bucketing, I mean that they'll think about different time horizons. So maybe a bucket of short-term cash or cash-like investments that are available to call upon in the first 1 or 2 years of your retirement, or the next 1 or 2 years. Then some medium-term investments that are less risky, so a mix of shares and bonds, to make sure that you do get some return out of them over the medium term. And then long-term investment to manage what we were saying earlier about sequencing risk. Long-term investments, typically equities that grow over the longer term. And then you can blend all of these above approaches depending on your own individual situations. But it's quite a complex task to manage this. So the investment industry has come up with a variety of solutions for you in terms of managing your investments in retirement. But actually, on the fund side of things, so excluding some of the investment trusts we've mentioned today, the fund industry doesn't make it that easy for you. In terms of the income available from your investments, actually the vast majority of funds out there only pay income twice a year. Now, I don't know about you, but most of my bills, utilities, direct debits are monthly. That's no good for me if I receive income every 6 months. There are some out there, about 20% that pay quarterly. That's better. Some people are used to that sort of pattern in terms of their salary and then transition into retirement. That might be useful. But even fewer take the monthly approach that we've talked about today again earlier. And we find the monthly approach is really useful because it allows you to manage your cash flows month to month like you have been doing throughout your working lives. Now, we've been looking at this concept quite closely. We've been running these funds for 6 years now, and we've stuck with the natural income approach. Now, the problem with that approach that we found is that actually dividends vary month to month. You can't manage or micromanage the underlying investments to make a smooth level of income. But what you can do in the fund world, you can hold some of the income back month to month and therefore smooth that income payment. And that's what we've moved towards. So we've no longer got the feast and famine that you can see because we don't think that's very useful for you as investors, that 1 month we're giving you a large dividend, and then the next month you're looking in your account and actually there's nothing there. So we've chosen to smooth the income from November last year. So you should receive 11 payments that are roughly the same. Actually, because of the fund rules that are out there as opposed to investment trusts, we can't carry the income from one accounting year to the other. So we have to pay out all of that income in any given year. So that means at the start of the financial year for the funds, it does present a challenge. So April, the month just gone, you will typically see a lower payment coming out of the funds. But for the rest of the time, we're going to smooth the payments off. And then at the end of the year, unfortunately not at Christmas, but in spring you'll get a bonus. So a spring bonus, if you like, not a Christmas bonus. The way that these funds are invested, as I said, are very diversified. We think of that in terms of asset classes. We're not stock pickers. We're choosing broad-based indices to fulfill different asset classes. We have an income fund, which is broadly like the 60-40 portfolio of old. And then we've got an income and growth fund, which is more heavily invested in equities because we're trying to achieve a level of growth alongside the income generation. And we're active in terms of how we manage these allocations. We move them around to areas of better value where we see opportunities longer term, so we can take advantage of opportunities and manage some of the risks out there at the moment. Now, I think, again, we've touched on it earlier, that the big risk out there that has come to everybody's attention this year has been around the US, the erratic policy making. And I think, by and large, most people have been broadly happy to let the weighting within the global indices drift and become blissfully unaware of how concentrated some of those indices are. If you just look at the global equity benchmark represented by this passive ETF here, it has over 70% of its portfolio invested in the US. We don't believe, from our perspective, that that's diversified enough for you. It poses too much of a risk, particularly around those magnificent 7 companies that everybody talks about so often. So we spread the risk in terms of our equity allocation. We do take some risk in the US. We think it's prudent to have an allocation to the US in the long term. But we prefer to have allocations to the UK, again, the traditional dividend market, but also other markets where there are opportunities out there. Europe is revitalising itself. They are looking for growth rather than looking inwards in terms of being very conservative with their debt management in places like Germany. Then we've got other areas like emerging markets where you've got exposure to India, and we've got China as well. Some areas where you can get higher growth and better valuation opportunities at certain points in time. So we don't think it's prudent to be really concentrated in one particular market, especially when you're going to rely on this income in your retirement. In terms of how we've performed since we launched these funds, so these assume that the dividends are reinvested over time. You can see that the 2 funds, in terms of their risk, are very different. You can see during the pandemic, obviously the income fund, being a more conservative fund, fell less than the income and growth fund. But it has rebounded. It rebounded quicker, of course, because it lost less. It didn't have to catch up quite as quickly. But as the environment has become more appealing to equity investors over the last couple of years, the higher risk fund has done better. But what does that look like when you're actually taking the income from the portfolio? What are we doing with the capital side of the equation? Well, you can see on the bottom here all of the dividends that you receive monthly. You can see they've been smoothed of late. And then you can see what the fund value has done. So since launch of these funds, you've received all of those dividends. So for £1,000 invested, you've received over £200 of dividends over time. And your ending fund value is higher than where you started. So we think, broadly speaking, we've done our job there. We've actually grown some capital. The income fund, in particular, looks to preserve the capital, so it's good to see that actually it has grown a little bit. The income and growth fund tries to not necessarily outpace inflation over the short term, but over the longer term, keep up with it. So in summary, those funds are looking to generate 3 to 5% income per annum. We measure that every 5 years on a 3-year basis. So in any given year, it's going to typically fall in that range, but it may fall out of that range for a short period of time. We think that's a sensible level to be targeting in retirement. We've smoothed the income, which has been, we feel, beneficial to end investors in terms of the journey that you're going on with our investments and our funds. And the funds are very diversified. As I said, we're not stock pickers. We're not relying on any individual companies, BP, Shell in the UK, any of the banks in the US, to pay us their dividends in any particular months. We're relying on broad-based indices out there. But we're not complacent when we're looking at indices. We're looking at actively managing to make sure that we're getting the best value for money in terms of the invested portfolio at any given point in time. And as I said, the costs, we're keeping a keen eye on costs, and we've recently brought the cost of these funds down to 50 basis points as well, which we think is an attractive proposition at the moment. So in summary, there are lots of approaches to income in retirement. It's not for me to tell you specifically what to do with your retirement funds, but we think there are some easier options out there, and 2 of our funds are some of the easier options for you in terms of managing your month-to-month cash flows, because we smooth that dividend income. And we think by being very diversified, it's actually a much safer way of investing over the long term than being too concentrated. Thank you very much.
Thank you very much.